makers and market movers. This is The Pulse with Francine Lacqua.
Good morning. Happy Friday. Welcome to The Pulse. I'm Tom McKenzie, standing in for Francine Lacqua this Friday. Now, Federal Reserve Governor Chris Waller, as I mentioned, says policymakers should cut US interest rates this month to support a labour market that he says is showing signs of weakness.
I believe that the Federal Open Market Committee, or FOMC, should reduce our policy rate by 25 basis points at our next meeting. So with inflation near target and upside risk to inflation limited, we should not wait until the labor market deteriorates before we cut the policy rate.
Has President Trump or anybody from his administration talked to you about potentially taking Powell's role?
Nope.
OK, let's bring in Bloomberg's Valerie Teitel. Valerie, is this a job audition for Chris Waller, of course, of the Fed, or is this a genuine concern about a labour market where we saw the jobless claims data yesterday suggests there's still a bit of resilience?
Look, you can definitely argue both, but this has been a consistent message since the beginning of the year from Governor Chris Waller. He's erred on the dovish side, saying he's not worried about the temporary one-time price hike from tariffs causing persistent inflation. He is more worried about the downside risks to growth. And definitely in this speech yesterday, Tom, he was setting up his reasoning for perhaps a dissenting vote at the July meeting in 2 weeks' time, saying that he's been looking at the labor market and he is getting a picture of a labor market on edge. He then goes on to say some pretty stark words about the labor market. At the same time, as you mentioned, we did have jobless claims come in better than expected. Even NFP last month came in better than expected. But to his mind, there are still a lot of revisions you have to take into mind. He wanted to revise out the additional public jobs that were added to that number in June. He also was notably talking about the BLS revisions that we've seen, maybe overestimating payrolls this year. So in his mind, the June NFP was actually in contraction, showing that the labor market is starting to show sign of cracks. Now, I do want to mention that he's also talking about the fact that the immigration policy from President Donald Trump is in some way warping this data. And you could argue in some manner it's been warping and distorting the jobless claims figures, which have fallen now for 5 straight weeks, the longest, winning streak for jobless claims in nearly 2 years. But in Governor Waller's mind, this comes down to distortion around the labor market, around the possible foreign-born workers leaving the labor market instead of saying anything good about the jobs market in the U.S., and he is backing an urgent rate cut in 2 weeks' time.
OK, and we'll see if others align with that view. Of course, it's the blackout period at the end of today. So 2 weeks. And then we have that decision, of course, from the Fed. Bloomberg's Valerie Teitel in terms of how to think about the labour market. At least one view on maybe some fragility there as we look at money moving into the Treasury markets. The benchmark 10-year currently yielding 4.43, yields down 1 basis point. And a reminder, Christopher Lowell joins Bloomberg Surveillance at 1 p.m. UK time. So certainly stay tuned for that interview before the blackout period, of course. We'll get more insights in terms of the views of the Fed governor. Now, the US is to impose preliminary anti-dumping levies on imports of graphite from China, saying it has been unfairly subsidized. Graphite is a key material used to make batteries. The 93.5% duty comes after US graphite producers asked for investigations into whether Chinese companies were violating anti-dumping laws. Let's get more from Bloomberg's EMEA News Director, Ros Madsen. Ros, how do you view then this additional duty on graphite within the context of the broader trade relationship?
Well, that is the big question. I mean, this is preliminary, as you were saying, so there'll be a final decision probably around December. So there's a bit of time here, but this is a key product, as you were noting, for in the battery space, in the EV space, and led by these US graphite producers accusing China of essentially subsidizing this product into the US. But you can imagine also for companies in the US, this is quite worrying news. Tesla, for example, will probably not be that happy if this does go through. And it comes at a time when you can see the White House working hard to actually reset the relationship with China. Donald Trump very much seemingly wanting that meeting with Xi Jinping perhaps before the end of the year. You know, there is a real effort to kind of like bring those ties into a better frame. And so would this impact that? Well, potentially. It does seem like it's a very targeted commerce action for now, and it's not final. And so hopefully they can put that in say this is actually something very targeted. It's not about the broader relationship. But as you know, everything somehow does seep into the relationship. And we've seen things like this, torpedo a positive moment before. I mean, we've seen things like the Chinese surveillance balloon that suddenly was accused of like flying spy balloons over the US, torpedoed the relationship as it was on an uptick previously. So we've seen this happen. Is this the thing that's likely to do that? Not necessarily, but it's going to be interesting to see the reaction from China in particular to this one.
OK, so we watch for that Chinese reaction potentially to that development. In the meantime, Scott Bessent, the Treasury Secretary, of course, of the US, is on the ground in Japan. Does that signal that we are getting closer, that the US and Japan are getting closer to a deal?
Well, yes, maybe, and no, maybe. It seems quite fraught. I mean, you saw Donald Trump talking yesterday again about Japan. His language is not particularly positive. He's accusing Japan again of sending, all these cars to the US not sending cars to Japan. Again, the protective veneer that Japan puts around its agricultural sector in particular. And so he is there meeting with the Prime Minister. He's also meeting with the chief Japan negotiator this weekend. But we've also got Japanese upper house elections, in a matter of days. And these are looking pretty fraught for Ishiba, the Prime Minister, and a question about whether, he will suffer in those elections. And of course, when you're looking at elections, protecting and supporting key sectors like auto and your farmers become very important. So there are a lot of roadblocks here to getting towards a deal, and certainly to announcing something before the election that may not be so favourable for Japanese automakers and for farmers. So you're not going to see major news this weekend on it.
OK, domestic roadblocks potentially to any trade deal with the US at this point, given the politics of Japan. Bloomberg's EMEA News Director Ros Matheson with that update. Ros, thank you. Now, finance ministers and central bank governors from the world's biggest economies are meanwhile meeting in South Africa at the G20 summit. The gathering is taking place against the backdrop, of course, of that presidential trade war, President Trump's trade war at least. Let's head across to Ballito near Durban and join our correspondent Oliver Crook, who's on the ground and has a guest with him. Ollie.
Yeah, that's right, Tom. I like that, the presidential trade war. That is sort of casting a shadow over these meetings here at the G20, multilateralism in the age of MAGA, and we'll be very pleased to be joined now by the Dutch Finance Minister, Eelco Heinen, who will join us now for his perspective and insights on the discussions that have been happening here at the G20. I'd like to start, if we may, just on those trade negotiations. We're now less than 2 weeks away from that deadline from the United States. Do you expect that the European Union will get a deal with the United States before August the 1st?
Well, we're working hard on it, and of course we need a deal. I think it's in the best interest of both countries, both nations. But we'll see. We saw it being postponed before, so we'll see.
Yeah. So in any sort of negotiation, there's always the stick and the carrot side of things. I know that everyone has been playing more on the sort of carrot end of things, not to upset the Trump administration. In this sort of last 2 weeks of these negotiations, does the EU need to take a slightly harder stand to demonstrate the kind of pain that this would cause the United States? For example, the anti-coercion instrument. Is that something that the Dutch would favor potentially putting on the table and potentially looking at U.S. services as well?
Well, all the time we're saying we need a deal. We need to de-escalate, and free trade is in the best interest of both. So that's what we're working on, but the European Union cannot sit still. So if we don't have a deal, we are forced to retaliate. I keep expressing it's not what we want, but it's on the table. And I'm not going into specifics right now because we're in the middle of the negotiations. But Europe is a large trade bloc, and once again, we cannot sit still.
And of course, the Dutch sort of sit at the sort of center of global trade in many respects, but also at the center of the world of semiconductors and chips, with ASML, the great champion, being a Dutch company, one of the biggest companies in Europe. What are your concerns around what we're hearing about tariffs potentially in the world of chips? What has your kind of contact been with the United States about potentially looking for carved outs for chips? And what are you sort of trying to lobby the EU to speak on your behalf on the question of semiconductors?
Well, we're not in direct contact to the Netherlands and the United States administration. Everything goes to Brussels, to the European Commission. So we are united in this, and of course we fight for the interest of the Dutch economy. ASML is a big part of that. It's an important company. It's also an important company for the United States, of course. Yeah. So that's what we keep expressing.
And so what do you, so in kind of lobbying, because obviously every member state has its input to kind of the message that Brussels brings to the United States, what would you like to be part of that message on the question of semiconductors?
Well, I'm not going to specific on semiconductors, but what we keep saying is like we need free trade. Free trade is in the best interest. Tariffs don't work. And if you are concerned about your trade deficit, you need fiscal consolidation. And you don't need tariffs. It's just a tax on American consumers. It will increase inflation. It's a bad thing, and that's what we keep expressing.
And one of the concerns that we've had in Europe is with the trade barriers between the United States and China elevating, a lot of that capacity coming over into Europe, which is really the only market that's comparable to the U.S. at absorbing some of that capacity. That, of course, threatens some of the competitiveness, which is one of the great priorities of the European Union at the moment. Do we need higher trade barriers with China in Europe in order to prevent that from happening?
Well, of course, we don't want dumping from Chinese products on the European market, which is going to hurt us again. And the United States is then concerned that the surplus in Europe will go to the United States. So this is an example that trade wars is not in the interest of anybody. So, but the European Commission is monitoring this very closely.
The European Commission has also put out a proposal for a budget that we got a couple of days ago. 2 trillion euros is the figure. We've had displeasure aired from Berlin. We've spoken to the Swedish finance minister here as well, who has had an issue with that figure. Is 2 trillion too high?
It's too high, and this proposal is dead on arrival.
Okay, how high? Too high by how much?
That I'm not going into, but for us, the Netherlands, I keep saying we need a smaller budget, not a bigger project, which means we need to reprioritize within the budget. And I don't think it's we should start with who can we tax, how can we spend more. We need to spend less, and that counts for both sides of the Atlantic.
Yeah, and I'd like to get your view also particularly on the corporate taxes that have been suggested by the EU, particularly in the spirit of this competitiveness that they're also trying to put forward. Your stance on that?
Well, of course, I'm not in favor of that one. But once again, I don't want to start the discussion about who can we tax.
Right.
The discussion should be about the budget, how can we reprioritize, and how can we spend less. And the starting point can never be to tax, and especially specifically not companies.
And so the sort of volume, the number is one side of it. The other question is also priorities. Are you broadly aligned with the priorities of the EU budget? Where would you like to see the sort of money shifted, not just in terms of its volume, but in its concentration within the priorities?
Well, we have new priorities. So security is, of course, a very important one. Innovation is a very important one. So these are the areas money should go to. But we are now at the starting point of negotiations. It will take 2 years. So I don't want to go ahead of things. But I think the position of the Netherlands is quite clear.
And on the question of defense, there's 100 billion euros that has been planned for Ukraine. Are you in favor, at least, of that part of the budget?
Yeah. So we need to keep supporting Ukraine. That goes both military support, budgetary support, and of course keeping pressure on Russia and putting extra sanctions on Russia.
And we heard from Donald Trump a little bit earlier saying that he's willing to sell more weapons to Ukraine if NATO and Europe pays for it. I'd like to get an understanding of what the Dutch's role is going to be in that. How much of that will come from a national budget? Do you see that being potentially done at the EU level? How are you thinking about that?
Well, actually, this is being discussed right now. So I'm talking about this with my colleagues in the European Union. How can we organize this? But I'm very glad to hear from President Trump that he continues his support also for Ukraine. Of course, there's also a monetary point in that. So who's going to pay for that bill? I think it's clear that Europe should pay for it, and how is now part of the discussions we're having among each other.
And I'd like to just get a flavor of some of the meetings that you've had here at the G20 with a lot of different sort of finance ministers, central bank governors, and this idea of multilateralism, this architecture that was really brought in by the United States, which the United States is basically now absent from. Bessent is not here, for example. Well, how is that changing the sort of conversations that you're having in these rooms? How is it reordering, in your mind, kind of the arrangement of multilateralism across the world?
Yeah, well, actually, everybody's quite vocal about the importance of free trade. So that's the good side of this discussion, that now everybody speaks out in favor of free trade, that we need less tariffs. So actually, we're quite united in this.
Eelco, Heinen, thank you so much. The Dutch finance minister here joining us from the sidelines of the G20 meeting. Again, this question of multilateralism in the age of MAGA and where these sort of trading relationships can now blossom further when the United States is receding from the international trade system.
Bloomberg's Oliver Crook on the ground for us with strong lines coming through, of course, with the Dutch finance minister at the G20, particularly when it comes to that EU budget proposal. €2 trillion EU budget proposal is, quote, dead on arrival, according to the Dutch finance minister. Ollie, thank you very much indeed. Coming up, US stocks hit new records. So is US exceptionalism back in action? I'm going to be joined by an investment strategist who advised clients to stay the course during April's sell-off. That's coming up. This is Bloomberg. Welcome back. So the S&P 500 hitting another record yesterday after strong retail sales data reassured investors about the health of the US economy. Joining us now is Matheus, Dibo, Managing Director in the Investment Strategy Group at Goldman Sachs Private Wealth Management. Matheus, thank you for joining us in the studio this Friday. So we had the retail sales data that came in stronger than expected with an increase of 0.6% on the month. And then the jobless claims falling for a fifth straight week, suggesting that at least on the surface, the labour market of the US remains relatively resilient. Is it your view that that relative resilience continues through the end of this year for the US economy?
That's right. So it is our central case scenario that the U.S. economy will not fall into a recession over the next 12 months. We do think growth will slow sequentially in the second half of this year, but the reality is GDP is going to be a very distorted measure of economic activity because of all the front loading that we saw in Q1 and the payback we'll see in Q2. But as we look at the underlying indicators, they continue to point to a resilient consumer, which drives 70% of U.S. GDP. So as long as the labor market remains okay, which it seems to be the case, we think the consumer will be okay as well.
Chris Waller calling for a cut this month and pointing to the labour market and saying if you strip out some of these indicators, some of the data, it suggests a weaker labour market than maybe some are assessing. Is the Fed governor wrong on that count?
So we are seeing signs of softness in the labor market. So initial jobless claims have trended a bit higher. New job postings have trended a bit lower. Private sector payrolls were soft last month. So there are enough signs that perhaps the Fed should start cutting soon. Our base case is that they will do so starting in September and that they will cut rates 3 times this year. So we think they will wait a little bit longer just to assess the data and look at the impact of tariffs on inflation and then the labor market before making their next move.
And that is against consensus, 3 cuts this year, because the markets, or at least the money markets, are pricing in just shy of 2,
That's correct.
And so just to be clear, the factor that leads to 3 cuts is less an inflation story and more a labour market story for the Fed, in your view?
That's correct. We think the Fed will view tariffs as a one-time adjustment in the level of prices of targeted items and not the start of a broader inflationary cycle, given the backdrop of a slowing economy and a soft labour market.
So transitory inflation, would you go that far?
We do think it will be a one-time increase that will drop out after 12 months. So it could be possible that if the Fed waits too long to respond to the softening in the labor market because of a temporary increase in inflation, it could be that they would be behind the curve.
On the question of tariffs, what assumptions are you and the team making as we lead up to August the 1st as to where, in aggregate, tariffs settle?
I think no one really knows. Our assumption is that tariffs will end up between 15 and 20%. So it's a wide range, but we don't know exactly. Of course, I don't think anyone does. But that is a 7. If you take the midpoint, that's a 15 percentage point increase relative to where we were at the start of the year. So again, it will lead to more inflation. It will lead to slower growth, but we don't think it leads to a recession.
And how are you looking? Where are you looking in terms of the tariff impact when it comes to the earnings story? We've had the banks reporting, very strong, of course. Which parts of the earnings story are you zeroed in on to try and get a sense of that tariff pass-through or not?
Yes. So we will be watching the consumer stocks, really, and what the companies say. I think guidance will be even more important to see how companies are handling the tariffs. So far, to your point, the Q2 earnings season is off to a very strong start. Only 10% of companies have reported, but almost 90% of them have beaten on EPS. So it's off to a strong start.
In terms of the Fed and the question around independence, as the pressure from President Trump continues on Fed Chair Jay Powell, his term, of course, coming to an end in May of 2026, do we still have an independent Fed in 2026?
So we did see, based on the market reaction that we saw on Wednesday, that the market is worried about that, right? When the news came out, we saw lower equities, a weaker dollar, and a steeper yield curve, which intuitively makes sense and seems to suggest that market participants are indeed worried about it. And in fact, Fed independence has served the U.S. economy extremely well for decades. The reality is no one really knows what is going to happen. We need to watch who the next chair would be. And even then, we have to remember that, A, we think the case for a rate cut is already quite strong starting in September, and B, the FOMC chair is quite influential, and the market participants will pay attention to every single word they say, but at the end of the day, they're just one vote out of 12 when setting interest rates at the FOMC.
Do you want to start advising your clients to position for potentially a firing of Jay Powell before the term ends in May 2026, or you're not going that far yet?
No, we think in this environment when there are just so many uncertainties facing investors, now is really not the time to be making huge portfolio bets. So we think sticking close to your strategic asset allocation and staying the course in equities in particular makes a lot of sense.
Okay, when it comes to the dollar story, given the pressure the greenback has been under, at least year to date, how much downside is priced in at this point? Are we starting to find a floor for the greenback?
Yes, our view is that the U.S. dollar will remain broadly range-bound into year-end. We have seen already a sizable move in the U.S. dollar, and it still looks overvalued. But if you look at where that valuation is coming from, it's really because the dollar is expensive against Asian currencies, most notably the yen and the renminbi. The dollar is broadly fairly valued against the euro and actually undervalued relative to the Swiss franc and the British pound. So on the basis of valuations alone, we don't see a compelling argument as to why the dollar would need to weaken significantly from here.
Okay, and we watched the yen after the elections, of course, of Japan this weekend and see what the movements are, given the fiscal spend that is expected from some, at least, from whoever takes the reins of power. In terms of the fixed income space, then, we've seen a bit of stability in terms of treasuries after the blowout of yields post-Liberation Day in April. What is your view in terms of how the curve reacts going forward, and how much is priced in around the fiscal spend and the budgetary impulse of this US government?
So yes, compared with current policy, the tariff revenues and the One Big Beautiful Bill Act will put the U.S. fiscal trajectory on a better path. But it remains uncertain.
It puts it on a better path?
On a better path. But
we're looking at maybe $3 trillion being added to the deficit.
That's right. But it's better than relative to current policy, right? The thing is, that trajectory does remain unsustainable over the very long run. So something will still need to be done. A fiscal adjustment will still need to be made in the future. But as we like to say, Rome wasn't built in a day, so it was just not realistic to assume we would be back to fiscal sustainability in one go.
And given your assumptions around the Fed cutting 3 times this year, do you want to lean into the front end?
So our recommendation is exactly. So we typically tell clients to target a duration of 4 years in their portfolios, and that continues to be the case. We think that 4 years is sort of the sweet spot between getting enough of a hedging benefit if equity markets go down from duration, but not being at the very long end of the yield curve where volatility is just much higher.
Okay, Matheus, thank you very much indeed. Matheus Dibo with some really smart insights in terms of these markets, given the volatility and the uncertainties around tariffs. Managing Director and Investment Strategy Group, Goldman Sachs Private Wealth Management. Coming up, we're going to explore the outlook for oil as the EU agrees to a lower price cap for Russian crude. We're going to be joined by Marcus Garvey, Head of Commodities Strategy at Macquarie. We'll also get his views on gold. That is next. This is Bloomberg. Good morning. Welcome to The Pulse. I'm Tom McKenzie in London. These are your top stories. Time to cut. Fed Governor Chris Waller calls for a rate cut this month to bolster a job market he describes as on the edge. The global stock rally continues after Wall Street equities notched another record as US retail sales rebound, easing concerns about the health of the US economy. Plus, the EU backs a fresh sanctions package on Russia over its war against Ukraine, including a revised oil price cap and new banking restrictions. More on that story now. Oil gaining then today as the EU agrees to that lower price cap for Russian crude, and data showing the US economy is holding up, of course, despite the fallout from the US-led trade war. We're joined now by Marcus Garvey, Head of Commodities Strategy at Macquarie. Marcus, great to get you on, great to get your views, particularly in light of this news around the EU and this 18th sanctions package targeting Russia. Does it move the dial, do you think, in terms of the oil complex ultimately?
I think as the market's pricing today, it's a pretty modest change in risk premium in terms of initial response, that no one is assuming that we're immediately going to lose barrels. And I think the backdrop to that really is twofold. We've had this extended period with multiple rounds of sanctions changes, and we haven't actually lost any Russian crude supply. So I think an understandable market response. And that also the backdrop to the market is that we have roughly sort of, in our view, about a 2 million barrel a day global surplus. So unless you actually did see this have a really substantial impact on Russian export volumes, you're not likely to tighten up the global crude balance particularly quickly.
How seriously should we be taking then the threat from President Trump of a 50-day deadline? We know these deadlines move, but potentially secondary tariffs on Russia, targeting India and China, the main buyers, of course, of Russian oil. How seriously should we be taking that threat?
I think that's a bigger threat than what we've seen today, in terms of if you get that, or also the package that's going through Congress at the moment, which is talking about 500%. But I mean, when you get to a 400% or 500% tariff, you're effectively saying, well, we're going to be stopping trade. So it becomes a little bit academic. If you were to see that come in, then I think it becomes a much bigger debate about, are we actually going to see something that starts to change? And there, I think the thing that becomes complicated is you're going to move beyond just, well, how is this impacting the oil market, to how is this integrating with the broader reciprocal tariff negotiations that you've got as we see into August, and you have things like the Geneva truce deadline coming up for renewal. Also, you still don't have clarity on where you're going to land on reciprocal tariffs with India. So it then becomes part of that bigger puzzle, I think, in terms of whether it's just an oil issue or where you land in terms of that full negotiation, because it's going to be part of that debate.
And you mentioned that 2 million barrel a day surplus?
Give or take,
yeah. Give or take. 2 million barrel a day surplus for oil. Is that a demand story, or is that an output story from OPEC Plus?
It's a really good question. I would say on an underlying trend basis, a lot of that actually is that demand growth is just pretty slow now. If you look at China, for example, we would argue that transport fuel demand in China has peaked really because of the arrival of EVs and the pace at which they've been gaining market share. And then on an underlying basis, also on the supply side, I think shale supply has continued to beat almost everyone's expectations. If you look, not say this year specifically, but we look at, like, say, the past 5 years. And then, to exactly your point, you've now had that faster than expected ramp back up in terms of OPEC plus supply that's put the market into a heavy surplus. A key issue, though, there is that if you look at how the inventories have evolved year to date, it doesn't suggest necessarily that the market is that loose, because so much of that surplus is actually built in China, that China's probably built 1 million or so barrels a day of inventory, and actually that the rest of the world has been comparatively tighter. And so that's actually kept the market, in terms of like the physical market indicators, I would say, in healthier shape than that kind of headline balance would otherwise suggest you would expect them to be.
Are you seeing any indications that the Chinese demand picture is going to evolve in terms of drawing down those inventories and pulling in more as the economy reaches for that 5% growth target?
I think if you had a bit of a price spike, maybe just on geopolitical risk premium or something, did genuinely tighten the market up, then you might see China reduce imports and you see some of that inventory get drawn down. I think in terms of an improvement in end demand, not seeing anything that would really suggest that at the moment. That transport fuel picture is relatively structural in its dynamics. And if you think about some of the more cyclically sensitive parts, the thing that could really move it, let's say, for example, construction picked up meaningfully and you saw a pull on diesel because of that, we're not really seeing anything to suggest. And if you look at, say, higher frequency indicators from some of the other commodity markets that are really close to that construction piece, say the amount of construction steel volume that's trading on a daily basis in spot markets in China, it remains very subdued, and we're not seeing anything on the policy sort of push that would suggest to us that's going to change quickly.
Okay, so in terms of some of those structural drivers for China, no huge turnarounds right now in terms of that demand picture. We know the real estate sector, of course, in China remains under pressure. Look, you talked about the geopolitical risk premium. Has that been completely priced out at this point? As we look at Brent around at $70, just shy of $70 a barrel on Brent, is that geopolitical risk premium all out of the pricing right now?
Maybe hard to say it's all out, but it's very, very low. I think that
is that surprising?
I think it's not surprising in the context of both that point in terms of what we've seen in terms of not losing Russian barrels, and then also we obviously had the Iran-Israel situation recently. The market again discounted it very quickly, and that also comes off the back of a series of Middle Eastern disruptions that also haven't led to any meaningful supply losses. So the market's got itself understandably into a mindset where these things are not actually going to see barrels taken away from the market, partly because I think just on a policy basis, what we've seen the US really show repeatedly, as well as other Western governments, is that they don't want to disrupt supply of oil. Maybe something will change that, but that has been the consistent policy approach. And so it's an understandable reaction from the market. The obvious point, though, is that does leave you in terms of the risk skew with a distribution that actually, where's the big surprise? It is to something that actually finally led to a meaningful loss of supply. The one caveat to that I'd say is we still have a reasonable amount of spare capacity. So unless you had something like, say, a Straits of Hormuz closure, where some of that spare capacity couldn't come to market, you're unlikely to see the market get really sustainably tight unless you had a very large supply hit.
On the question of copper, 50% tariffs being threatened. Are the distortions in the copper market, have they been worked through, given that 50% tariff threat? Where are we in terms of the copper market adjustments to that?
It's still very much ongoing, and I think still very uncertain because we don't know the full details of what that tariff is going to land on. Not just in terms of that headline number, let's assume that 50% number is what we get, but which forms of copper does it apply to? Are there any restrictions on trade associated with it? Because as much as the US is a net importer of copper metal and also copper products, they export a lot of copper scrap. So broadly speaking, the imposition of this tariff is net bearish for the LME price, and we've seen a bit of a pullback in price because you'll lose this excess US demand as people have front-run tariffs and pulled metal into the US. And so you'd expect LME price to fall a bit. The CME price in the US goes up because it has to reflect that tariff. We've seen that move up to a 25% premium at the moment, so it's not gone to the full 50. But what if you actually got something like a scrap export ban? That's not a base case, but it's a meaningful risk. Suddenly, you would lose about 500 to 600,000 tons of supply from the US that comes to the rest of the world, and you'd actually tighten up the rest of the world market, and it would become a bullish dynamic. So you've still got quite a few uncertainties to work through. I think where we would expect the market dynamics to land, assuming you get that 50% tariff, is the US premium should probably be between, say, 35 and 40%. But then what happens is as you work down the excess inventory that has been built in the US ahead of this, you'll get this gradual sort of decay into pricing a near 50% tariff right at the front end of the curve in the US, because then you'll be pulling in marginal import material. But until you've worked down, give or take, a 400,000 ton excess stock that's been accumulated in the US, you don't need to price in the full tariff, and so it's reasonable that the market isn't doing that yet. Okay,
mapping out the scenarios really nicely for us in terms of the questions that still need to be answered for the copper market, and how, and depending on those questions and those answers, that copper market and the pricing adjusts with maybe a 35 to 40% premium in the US market initially, at least. Marcus Garvey, head of commodity strategy at Macquarie, in terms of insights, of course, into the oil markets and copper as well on those tariff threats. Now to the banking space. HSBC is disbanding a team focused on identifying and managing geopolitical risk. Talking of which, Bloomberg understands the move will impact fewer than 10 roles across Asia, Europe and other regions. The London headquartered firm is the world's largest trade bank, of course, and an anchor of commerce between the Asia-Pacific region and the rest of the world. The US Congress has passed the first federal legislation to regulate stablecoins in a watershed moment for the crypto industry. It paves the way for the broader use of stablecoins in everyday finance. The measure is now on track to become law. Bitcoin hit an all-time high earlier this week, partly on optimism about the stablecoin bill's prospects. Netflix lower in pre-market trading. You can see that down 1.3%. That's despite reporting second quarter results that exceeded analyst expectations in every metric, with revenue topping $11 billion. The world's most popular paid streaming service also raised its forecast for full-year sales and profit margins. For more, let's bring in Bloomberg's Shirley Zhao with the details. Shirley, what are the reasons then for Netflix's better than expected results? They beat on pretty much every metric in the second quarter.
Yes, so Netflix's performance for the second quarter did come as a surprise because the second quarter usually is slower for Netflix because it typically adds subscribers at the beginning and the end of the year. But during this quarter, two of Netflix's most popular shows were released, including the third season of Jen and Georgia and the final season of Squid Game. So these two shows have helped boost Netflix's performance for this quarter. And there is also the currency exchange volatility. The US dollar has become weak and more than 2/3 of Netflix's viewers are outside of the US, and that means their currencies are becoming stronger against the US dollar.
Okay, so the currency impact is there as well for Netflix. What are the challenges for this streamer in the months and quarters ahead, Shirley?
So Netflix does face quite a few challenges, and first, its share of total TV viewing in the U.S. hasn't increased over the past year, and its average viewer hasn't really watched more TV than before, and it's facing increasing competition in this field with more competitors joining in, especially in the Asian market, which is one of Netflix's biggest markets in terms of growth potential. We've got these kind of competition, and also there is the valuation of the company. Netflix's share prices have almost doubled over the past year, and it's now trading near a historic high. And that means if Netflix's earnings are anything short of meeting investor expectation, there could be a letdown, and that may reflect on its share prices.
Okay, priced for perfection, maybe. Bloomberg, Shirley Jiang, on those Netflix earnings, thank you very much indeed. Staying with TV, The Late Show with Stephen Colbert is to air its final episode in May of next year. Colbert, who hosted the programme for a decade, announced the programme's end during a taping yesterday. Colbert replaced David Letterman, who created and hosted the show for 22 years. CBS, owned by Paramount Global, said the cancellation was purely a financial decision against what they described as a challenging backdrop in late-night TV. And the CFO of TSMC has told Bloomberg the company plans to be cautious with capital expenditure because of the uncertainties around tariffs. The chip giant reported stellar earnings yesterday that beat estimates across all metrics. The CFO, Wendell Huang, has been speaking to us exclusively.
Basically, tariffs will not directly impact us, but it will impact the end markets. So if the end market's demand drops, and ultimately it will affect us. We do have certain assumptions in there, which I think everybody has its own assumptions on how much impact there may be.
Okay, TSMC's CFO speaking to us exclusively. Coming up, G20 finance chiefs confront the impact of President Trump's tariffs as hosts South Africa call for greater cooperation. We'll have more next. This is Bloomberg. Welcome back. Well, on his first visit to Britain as German Chancellor, Friedrich Merz has signed a treaty that includes a commitment for the two nations to assist each other in case of armed attack, part of a wider reset of post-Brexit ties between the two countries. London Bureau Chief Ruth David joins us now for more. What are the details then, Ruth, of this treaty signed between Germany and the UK?
Hi, Tom. So, of course, there is the commitment to defend each other, closer cooperation on nuclear arms, because Germany is not a nuclear state, but they are, the third largest exporter of missiles to Ukraine. And one of the clouds hanging over this time has been with the US pulling back. What are Germany and the UK and France doing? It seems very much like the London, Paris, Berlin triangle is back. This comes on the heel of President Macron's visit last week, where there was this agreement. And it also is, so they're talking about defense. They're talking about exporting more together, bilateral treaties there. They already work together on some things like the Eurofighter Typhoons and the Boxer armored vehicles, but they're looking at a long-distance ballistic missile, developing that. But there's also things like, it's going to be easier to travel between borders, and that's good for us. It's going to be easier to have more student exchanges. Merz has been quite vocal about how he deplores Brexit, so this seems to be putting back some of the alliances that were in place when the UK was in the EU.
Yeah, and some of those travel easing measures may come into place as soon as this summer, we hear, in terms of e-gate. When it comes to the military component of this, and particularly support for Ukraine, what do we hear about how the two countries, the UK and Germany, may be partnering or at least working together to support Ukraine?
Yes, and so yesterday Keir Starmer was hinting that, the UK and Germany might be teaming up or might look at teaming up to buy missiles from the US as part of the NATO alliance and then to send it to Ukraine. So we're seeing that happen. I think it's also interesting to keep in mind that this is happening while both leaders are facing a lot of challenges domestically, right? And we are looking at these talks in the light of Merz saying now that he's against the European Commission's budget proposals, which would include Germany spending $500 billion more. So all of these things are happening, and then there's this little bit of a ray of hope where they're signing these agreements, and they're both saying we're committed to these closer ties between us as we look at a new post-US alliance.
And the domestic political challenges are there as well in the shadows, aren't they, as you say. Ruth David, thank you very much indeed. Our London Bureau Chief, of course, on those meetings between the German Chancellor and his UK correspondent, the Prime Minister, of course, Keir Starmer. Now, President Donald Trump has authorised the Justice Department to seek the release of grand jury testimony from the prosecution of Jeffrey Epstein, bowing to mounting pressure for more transparency about the late disgraced financier. Trump's move came after the Wall Street Journal published a story alleging that he once sent a suggestive birthday letter to Epstein. The president called the letter fake and threatened to sue the paper. Meanwhile, President Trump has been diagnosed with chronic venous insufficiency, a common condition causing swollen ankles. The White House medical unit says he remains in excellent health with no signs of deep vein thrombosis, heart failure or systemic illness. Doctors attribute recent hand bruising to aspirin use and frequent handshakes, calling it benign. We had some lines crossing in the last couple of minutes in terms of a response, or at least a view from the ECB's Nagel, a member, of course, of the Monetary Policy Setting Committee at the European Central Bank, talking about Fed independence. So a view on the Federal Reserve there coming from Joachim Nagel, of course, saying challenges to Fed independence could be felt beyond the US. This, of course, after and during which, of course, President Trump has ramped up that pressure on Fed Chair Jay Powell. So Joachim Nagel of the Bundesbank, of course, but also of the ECB, saying that challenges to Fed independence could be felt beyond the US, should not play with central bank independence. So a warning there from Joachim Nagel not to play, as he's described it, with central bank independence. Now, back to the G20 summit where Joachim Nagel was speaking. Finance ministers, central bank governors, the hosts, South Africa, calling for greater cooperation as finance ministers and central bank governors gather, of course, under the cloud of President Trump's trade war. Let's talk to Sanusha Naidu now, senior research fellow at the Institute for Global Dialogue, someone as well with deep expertise on China and the interlinkages between China and the continent of Africa. Sanusha, what for you have been the key takeaways from this G20 meeting? Is this a talking shop or is there real consequential cooperation that's coming out of this meeting?
A good day to you and to the viewers. I think the key question is really around finding the consensus around the document that needs to be put together by today that can go to the G20 summit in November. And that's a big challenge for the finance ministers at this meeting, because the consensus is really around key issues around the issue of the trade protectionism, the debt distress question. But more importantly, I think it's also around what was alluded to just now about the independence of the central banks, how much of political leeway do they have, and of course making decisions regarding the financial architecture, and bearing in mind that we also have to deal with the cost of capital and how cost of capital is impeding and impacting negatively on African countries in sub-Saharan Africa around issues in terms of how much it takes to actually borrow, but also in terms of money that is being used to remit and so forth. And so this is a big question in the meeting in the last 2 days around how do you actually ventilate a more kind of defraying of the costs when it comes to transactions in terms of whether it's the SWIFT system, which is also an impediment to the financial architecture, and the currency questions and volatility. So I think the consensus is the big question of what they're going to reach at the end of the 2 days.
Does it matter that the US is not there with a senior delegation? The Treasury Secretary, Scott Bessent, is not on the ground at the G20. Is the US listening?
Well, it's a difficult one to actually comment on because you're getting differing or varying interpretations. You've got, for example, the finance Sherpa track, which is the finance ministry in South Africa, the the Director General Duncan Peterson and others who have said that this hasn't deterred the meeting. It hasn't created any kind of bottleneck without having a senior administration from the U.S. representative at the meeting. This happened also in February, where there was no senior representation. But again, the question is, what will be the consensus document that will then find traction with the U.S. as an incoming chair of the G20 at the end of this year and beginning of next year. And that's going to be critical because a lot of these issues actually fit very smugly and intently in the mind of the Donald Trump presidency, whether it's around the question of the BRICS financial issues and the issue around the tariffs, the question of the role of the dollar, and the transboundary issues that actually impact on the cost of capital, like things like climate finance and issues relating to illicit financial flows, debt sustainability, questions of how much of debt Africa pays in terms of interest repayments and the impact that it has. So these are all kind of sitting kind of smack bang in the middle of some of the issues coming out from the Trump presidency around what does it mean in terms of the US's global financial footprint and the impact that has for other countries.
And all of this, to your point, at a time when the US is threatening 30% tariffs on South Africa by August the 1st, and potentially an additional 10% is what's been threatened because of their association and grouping with the BRICS nations. Is it your sense, is South Africa any closer to coming to some kind of agreement with the US when it comes to trade?
Well, what we're hearing is that there is trade talks happening, that the Department of Trade, Industry and Competition, which is the equivalent of our Ministry of Trade, is in negotiations and talks with counterparts in the US. We are seeing that there are other stakeholders like the union has also been part of the discussion in terms of AGOA. But I think at the end of the day, it's very difficult to try and pinpoint what is going to happen in terms of these discussions. Perhaps this is also part of the fact that it's a very unpredictable Trump presidency, so you're not really sure what it means when you talk about these kinds of discussions. But hopefully this is something that will be looked at in a more bigger question. I think, what we really want to think about here is, again, it's not just about South Africa, BRICS or whatever. It's about a global issue and how this is undermining and creating more fragility in terms of global trade, and the protectionism issue on the trade linked to the currency question, linked to the cost of capital, and how much of this is going to impact not just South Africa, but in fact the US economy more directly.
Just very briefly before we let you go, what's China's role been? Are they taking advantage of the US stepping back?
Well, the Chinese have always played that role in terms of being politically very visible in Africa, politically very visible in terms of what they want to achieve with their global frameworks like the Global Development Initiative and so forth. But again, it's difficult if you think about this little mini summit. There's been mini summit that Trump had with African countries around critical minerals, peace, and of course other issues. So again, I would say that it's transactional.
Yeah. Sanusha Naidu with that insight, Senior Research Fellow at the Institute of Global Dialogue. Thank you for those views on the G20. Up next, Bloomberg Brief. European markets are up. This is Bloomberg.